Hey guys, how's it going? It's Andy from Magoo Investing. Happy Tuesday. In today's video, now that I've moved up to Portland and I've been here for like a month and a half, I've met a lot of people or I've seen a lot of people that I haven't talked to in a while. And usually the first question is after you've graduated from college is like, what do you do for a job? And right now I'm explaining that I've been making YouTube videos. And one of the first questions I get, either they say, oh, that's interesting, or they ask, oh, I've always wanted to get into investing. How would you recommend getting started? And so in today's video, I'm going to kind of lay out the groundwork for how I would start a new stock portfolio at this point. The title does say how I would start it with $1,000, but at this point, the stock market is the most accessible it's ever been. And so money is not really a deciding factor anymore. Back just a couple years ago, money for how expensive each of the stocks were was very important for how you would kind of organize your stock portfolio. Because say you only had maybe $200 to invest and you wanted to buy into something like an Apple. You wouldn't have been able to if it was over $200. But now we're able to buy fractional shares, which has made it so that you can make your stock portfolio look exactly how you want to. And so $1,000 is just kind of a generic way for how I would start a stock portfolio. But the dollar amount doesn't really matter. It's more about the percentages. So in this video, I'm going to lay out the 4 stocks that I would put into my stock portfolio, give the reasoning why, and kind of explain the main ideas I'd be thinking about for how I'm building this portfolio. But before we get started, I do have to say that I'm not a licensed financial advisor and this is not financial advice. Anything you hear in this video is just me giving my own opinions for how I would start my stock portfolio, and you need to do your own research. Also, if you've been enjoying these videos, really appreciate it. Hit that like and subscribe button, as it would help my channel out a lot. With that out of the way, let's talk about the 4 stocks that I would be buying to start my new stock portfolio if I had to get started right about now. Okay, so if you've been around my channel at all, I kind of have a way of picking my own stocks for my current stock portfolio, but that's going to be very different for if I was starting fresh right now. The way I buy stocks right now is I buy mainly companies that are beaten down, stuff that I can get at a discount, because the way you make a lot of money in the stock market is you buy stocks at a discount. You don't buy while things are high, you buy while it's low. And if I was starting over right now, I think it's important to have a nice mix between being very aggressive and picking some very safe stocks overall. If you're starting a new portfolio, I think personally that it's important to be pretty aggressive, because if you start with $1,000, yes, that's a lot of money. If you buy stocks that are some of these tech stocks that have done very well, they could shed 40% of their value pretty quick based on how overextended they are right now. And so I think it's important to buy some of these undervalued stocks, but also to kind of hedge your portfolio by buying some of these blue chip stocks. So this video is going to be a mix of some beaten down stocks and some of the top performers that I would love to have in my portfolio for years to come. So the first stock on this list kind of goes under the beaten down stock, but it's actually one of the blue chips out there. And the first stock that I would be buying would be Disney, ticker symbol DIS. And so currently Disney is trading for $130 and it's down 10% in 2020. When you compare that to some of the other major blue chip stocks out there, it's one of the only ones that you're going to be able to find at a discount. And I think it's a fantastic company that has a lot of upside potential, but gives you the stability of buying into one of these massive companies. And so shares were up 3% on Tuesday after the company came out and said that they were going to be focusing more on their streaming and direct-to-consumer products. This has been an interesting change in the company. This has been a company that's been mainly about making movies, putting them out to movie theaters, their cruise line, their amusement park, stuff like that. But with the pandemic going on, there's a lot of question marks on how the company was going to be kind of organized running forward. And they've said they're going to focus more on the direct-to-consumer stuff, which is something that the investors really like to hear. And so in May, Disney Plus recorded 54 million users, and they expect to see 200 million by 2025. And so this is where the company expects to see a lot of growth going forward. The company also owns Hulu and ESPN. They have a bundle where you can put all of those streaming services together for $15 a month. And it's something that I am actually considering right now. And so the company has cut 28,000 theme park jobs at the end of September as a result of not being able to open fully. And so this is one of these companies that would benefit greatly from the reopening process after the pandemic kind of slows down a little bit. And that's always been very attractive for me. And I'll explain 2 companies from now how I'm going to be taking advantage of the reopening process. But Disney has one of the most attractive futures for me. They have the benefit of being one of these massive companies that you can buy at a discount. They're focusing more to the direct consumer, which is going to be very profitable for them overall. In one of my last videos, I talked about how Microsoft and Sony have gotten really smart and kind of choked out GameStop by trying to control the used market. And for a company like Disney that makes all these movies, having their own streaming services instead of selling them out to a company like Netflix has been very profitable for them, as they have 54 million users at this point. And so they've been testing out some new things. Now that all of the movie theaters have been closed, they decided to do a direct-to-consumer release for Mulan, which I thought was a really interesting idea. And from what I found, they had it for $30, and they had 9 million accounts that bought it, bringing a total of $263 million in revenue, which is not what they would have done if they just released it in movie theaters. So I think this is going to be something that a company like Disney is going to try a little bit more in the future. They probably get a higher percentage of the profit because it's going straight through their service instead of having to pay it out to the movie theaters. And I think we're going to see a lot more of that, especially as a lot of these movie theaters are failing. So if we see more of this happening, I think Disney is a company that will be doing very well at doing the direct-to-consumer because they already have the interfaces to take advantage of that. So Disney overall, down in 2020, has a bright future. The reopening process is going to be very great for them, but if it takes a little bit longer than expected to open, their streaming services are going to kind of pick up the slack for the rest of the company, and that's why it's going to be the first stock on this list. And so the next company I want to talk about is actually going to be two companies that I would kind of flip-flop right here. I'm talking about Microsoft and Apple, and these are two tech giants that at this point I wouldn't really care which one I put in my portfolio. I personally wouldn't buy both of them, but I think having one of them in my portfolio would be strong just based off of their incredible returns in 2020. Microsoft is up 41% this year, and Apple is up 68%. Apple jumped on Monday after anticipation for the iPhone event that's going to be happening today, probably after I've already released this video. And so Apple relies heavily on the iPhone sales for their revenue, which is something that I've kind of knocked them in the past on. But I've heard a lot of positive things about the rumors coming up about the iPhone, and it's one of these super well-established companies that I'm not worried about going forward. Around 50% of their revenue does come from iPhone sales, but they've done better recently at kind of diversifying their revenue sources with their wearables, the iPad, some of the computer stuff, and so it's not as reliant on a successful iPhone. But overall, I like Microsoft a little bit more. Put up on the screen right now their three revenue sources coming from their personal computer, their cloud services, and then their business stuff, which is like a 33% split between all three of those, which I think is very attractive. I think having one of these stocks in a new investment portfolio is always a great idea. It's one of these companies that is going to continue to go up over the years, and I'm not really worried about the day-to-day chop of the stock. And so this is kind of the safe stock that I would be putting in my portfolio, and I don't really care to pick between Microsoft or Apple. I think both of them are great opportunities. And now we're going to go into the somewhat riskier of a position, and it has a fantastic upside, and it's a stock I've talked about a lot. We're going to be talking about Southwest, ticker symbol LUV. So if you've missed any of my videos talking about why I like Southwest, it kind of boils down to a couple main things. I think the airline industry overall is in a pretty good spot. You've had some negative news about having to lay off jobs, but when it comes to stock price, laying off jobs isn't as bad for the share prices you might expect because it usually reduces overall costs, and shareholders always like to see that because it is going to bring in a better bottom line. And so I think Southwest is going to be the best airline based off of their focus on domestic travel, and they don't have to worry about the reopening process when it comes to different borders, which is going to be a huge political conflict going forward. Also, they're going to benefit from the reopening process. They have cheaper costs compared to the other major airlines, which I think is going to be a very positive thing for, I'm assuming a lot of these consumers are going to be very price sensitive, considering we've come out of a really tough economic time. Actually, we're still in it, but I think price is going to be a very important factor for which airlines people are going to be booking, but it's going to be very risky because it's very dependent on how well the pandemic response goes. Obviously, at this point, we're on month 7 of this, and it doesn't look like we have an end in sight. And it's going to be very interesting going into the holiday season, which is one of the most important times for air travel. And it's going to be very interesting to see if people are willing to travel or if there's going to be extra restrictions put in place that's going to limit that sort of travel. And so going forward, this is going to be a riskier position. But as I mentioned, if I'm starting a portfolio with a lower dollar amount, I think it's always good to be a little bit risky because that is how you start your portfolio off well. Obviously, if I was putting in like 20 grand, I wouldn't want to risk all of it on something like a Southwest. I could go down significantly. But if I'm trying to jumpstart a new portfolio, we already have these safer plays in Disney and either Microsoft or Apple. And I think having a little bit of risk in the portfolio is always a great thing. So I think Southwest, ticker symbol LUV, is going to be the best airline stock. And I think it's a great thing to have in pretty much any portfolio at this point. It is a member of my portfolio, and I have done very well in it so far. Right now I'm up 25%. And in a normal year, you're going to be hoping to average 10%. So Obviously, this year is a little bit different, as we've already talked about. Microsoft is up 41% and Apple is up almost 70%. So not a normal year, but I think Southwest has a fantastic opportunity to bounce back, and that's why I decided to put it in my new portfolio. And then the last stocks I wanted to talk about are some of the top performers of the year, and that's going to be with PayPal and Square. That's PayPal, ticker symbol PYPL, and then Square, which is ticker symbol SQ. And so the digital payment platforms have become crucial as we've had the lockdowns, as people are not going out and spending money in physical stores as much. We've seen some problems with coin shortages, and it's really interesting. But so far, these two companies have done incredibly well in 2020. PayPal's up 90% and Square's up 205%. So this usually goes away from my normal investing kind of strategy of picking beaten down stocks. But as I mentioned, if I'm starting fresh, I want a little bit of stability, and I want to be picking stocks that I know how they work, and I'm very confident in their business. And PayPal is something that I use almost every day with their Venmo. I don't love Square as much, but I think focusing on digital payments going forward is going to be a very good business to invest in. So that's why I decided to have there. And so in the last quarter, PayPal saw a 30% growth in total payment volume year over year, a 22% in revenue growth year over year, and their last quarter had a 112% increase in free cash flow. So this is a business that is spiking with the pandemic, and I expect it's going to probably drop in volume as things go back to normal, but I think the reliance on digital payments is going to increase over time. And I think picking the best company in a specific sector is always a great idea. And I personally think that PayPal is that. Obviously, Square is up 200% so far in 2020, so it has outperformed it. But I'm going to take the stability of something like a PayPal over Square. But I decided to talk about both of them because they're pretty similar, and I always think it's better to invest in a company that you personally use. And while I don't love Square, I know that plenty of people use it. I believe they're the ones that own the Cash App. Could be wrong about that, but yeah, I think that's a great way to round out the portfolio. And so with these four stocks, I think it gets a nice mix of some of the blue chip stocks, some of the companies that aren't going to be going away anytime soon, stuff like Disney, Microsoft, Apple. You have the potential for incredible growth with Southwest as they bounce back as the pandemic hopefully wraps up eventually. And then you have the digital transaction companies with PayPal and Square. And so that is personally how I would start a portfolio with $1,000. I'd probably try to break it up 25% for each of them. I think it's really important not to break up your portfolio too far, because if you're picking stocks that you really believe in, say I go into Southwest and it goes up 100% in a year. If it's 25% of my portfolio, it will be a huge boost to my account. But if it's only like a 5% because you own 20 stocks that are all 5% of your portfolio, you're not going to see as much of the gains, and it's going to average out. It's just the law of large numbers. When you have more of them, it's going to average out to the mean, which is usually going to be around 10% a year. And if you have too small of a position in each of these companies, you're not going to be able to reap the rewards if things go well. So this is personally how I would do it, and I'm very curious to see how you guys would start your portfolio with $1,000 in the comment section down below. Thanks for watching. I appreciate all the support, and I will see you on Thursday.